One of the hot topics in the hallways of the Jackson Hole Conference right now is the future of Fed Chairman Ben Bernanke. His term in office expires January the 31st. And let's take you out live to Jackson Hole, where we find our own Kathleen Hayes. She's sitting down with Columbia University Business School Dean Glenn Hubbard. Kathleen?
Thank you so much, Margaret. And of course, Glenn is also an official, former Treasury Secretary himself. So let's bring him into the conversation on this very important question, Glenn, of Ben Bernanke's renomination, because it's not the official topic, but it's certainly one of the unofficial topics. What do you think?
Well, I think there's no question that the Fed, under Chairman Bernanke's leadership, has played a major role in improving the situation that the financial crisis gave us. So I think the bar for not reappointing him would have to be very high. I think most economists would believe that he's done a very good job and should definitely be reappointed. There's only one person opinion who counts, and that's the president. But for economists, yes, definitely reappointed.
We know one of the arguments I've heard, too, is that right now what the Fed needs is continuity, because this question of the exit strategy is going to be so tricky to pull yourself away from all the credit and liquidity and do it at just the right time so you don't derail the recovery and you don't go too slowly and let inflation get out of hand.
I think you can make an argument for continuity. I could also make an argument the other way if I wanted to. I think the more relevant reason to champion Ben's reappointment is his skill set, that it's really married very well to the problems that we have. These are instruments and vehicles that he played a strong part in creating, and for that reason, I do think he should continue.
You know, when he talked about this nascent recovery, right, that we seem to be getting closer to that, and mentioned the kinds of stimulus we've had, it seems to me right now there's a very divergent set of viewpoints. One is that the stimulus is working, and it's going to create these multiplier effects that carry us up onto this recovery plane, and the other one is it's kind of artificial, and what the economy is doing well while the stimulus is there, but once you pull the stimulus back, we risk, another downturn, or at least an economy that really doesn't get going.
Well, first of all, I don't think there's abundant evidence to suggest that the stimulus package is working very well at all. It wasn't very well designed. What has been effective is the interventions in the banking sector and financial markets that have brought down spreads and improved investment potential and housing potential. So I think the reaching for yet another stimulus would be a big mistake.
You don't think cash for clunkers have worked, or the first-time home buyer tax credit? We just saw existing home sales up 7%.
I think there's certainly directional effects of both, but if you look at the improvement that we have seen in growth over the past 2 quarters, the sectors improving don't look that correlated to the sectors with stimulus. I think all in all, it would have been better to have stimulus focused on better policy.
Now, I bet you would think that tax cuts would have been a good part of it. Do you still think there's a need for tax cuts, that would make a difference? Is there any chance that would happen now?
I don't think temporary tax cuts are likely to have much of an effect. I think the kinds of tax changes that might have had an effect would be clarifying intentions about the long run. The fact that the administration is announcing large future tax increases on things that have very large economic effects, I think that's a huge mistake. But I don't think there's much of an argument for temporary tax cuts right now.
Not needed.
Well, I don't think they'd be very effective.
Anyway, so what about banking reform? Because that's what this conference, one of the big things it is focused on, and a provocative paper presented this morning suggests that the central bank should be sort of the backstop in financial crisis by providing insurance contracts. Do we need something like that? Or more broadly, Glenn, what do you think the #1 bank reform should be this year?
Well, what I do agree with in the paper that was presented this morning is that we need to think harder about capital requirements and have them move more over the cycle. The proposal this morning about insurance is like contingent capital proposals. But I think having the Fed write insurance, unless it's very carefully monitored, runs the risk of real moral hazard, of banks just taking on too much risk.
So, Glenn, how does the global economy look to you now? You spent a lot of time in China. The business school has a very strong relationship over there. What's your view, I guess, globally and particularly with China?
Well, globally, we're starting to see recovery in some parts of the world. Recent Japanese numbers have been very good. While China's slow, it's still rapidly growing relative to the industrial economies in the West. But growth is still imbalanced. And we still need emerging Asia much more focused on domestic demand and the U.S. much more focused on exports.
Okay. Glenn Hubbard, thanks so much for joining us.
My pleasure. Thanks.
Margaret, we'll have another guest in the next hour. For now, we're going to send it back to you.
All right, Kathleen, thanks for all your reporting live from Jackson Hole.